Today, we're going to break down what a trailing stop is and why every trader should know about it. In this video, you'll learn how this tool works, why it's called trailing, and how it helps you lock in profits without capping your gains. Stick around till the end to find out how to avoid losing money when trends reverse and how not to exit a trade too early. Don't forget to like the video and subscribe to the channel. Imagine wearing armor that adjusts with every step you take. It protects your back, but still lets you move forward. That's exactly how a trailing stop works. It's a trading order that automatically follows the price of an asset. Some people also call it a ratchet stop, like the ratchet mechanism that only moves in one direction. Unlike a regular stop loss that's set at a fixed price, a trailing stop is flexible. It doesn't stick to one number. Instead, it moves along with the market, keeping a set distance. If the price goes your way, the stop follows. If the market turns, the stop stays put. Once the price drops back to the stop level, the order triggers and your position closes. This behavior makes the trailing stop a powerful tool. It protects you from serious losses while still allowing your profits to grow. That's especially useful in trend-following strategies, where the market moves in one direction for a long time. But there's a catch. Trailing stops aren't always easy to use. A lot of traders don't know how to handle them, and that's a mistake. In the right hands, a trailing stop can squeeze every bit of value out of a move while still keeping you safe if things turn. Join our Telegram channel for updates on new videos and articles. You'll find the link in the description or pinned comment. Let's say you opened a long position and bought shares for $100. The price goes up to $120. You want to lock in some profit but don't want to miss out on more upside. That's when the trailing stop becomes your best friend. You set the distance, say $10. That means the stop will always stay $10 below the current price. At $120, the stop sits at $110. If the price climbs to $130, the stop moves up to $120. But if the price drops to $120, the stop doesn't move. And if the price continues down to that level, the order triggers and your trade is closed. You take the win and exit before the market takes a dive. That's the magic of the trailing stop. It lets you ride the trend without sticking around for a crash. It locks in your gains while keeping you in a safe zone. That's huge for anyone who doesn't watch the charts in real time. Automation works for you here. It protects you without needing constant attention. It builds your confidence and makes you a more disciplined trader. If the market heads down, the trailing stop stands still. It freezes in place, like a guard on duty. And that's the key. A trailing stop only moves when your profits grow. It never moves closer when the trade goes against you. This protects you from panic moves and gives you a clear exit plan. When the price drops, the stop just stays where it is until the price hits it. Then the order executes, closes your position, and locks in the result. That's why this tool shines during strong trends. It helps you avoid bailing too early. Markets don't move in straight lines. They zigzag, one step forward, half a step back. Regular stop losses often get triggered by those little dips, and you're out too soon. A well-set trailing stop, though, keeps you in the trade as long as the trend is alive. Set the distance too tight, and you'll get knocked out by even small pullbacks. Set it too wide, and you could lose a chunk of profits before it activates. The art of trading is finding the sweet spot in between. That takes observation, analyzing past price moves, and understanding how volatile your asset is. One of a trader's biggest fears? Losing everything in one move. That fear gets real in margin trading. Even small price shifts can wipe you out. This is where the trailing stop becomes your shield. It limits your loss to the level you set. If the price moves against you, you won't lose more than you're willing to risk. But unlike a hard stop loss, it doesn't limit your upside. If the market goes up, you go up with it. That gives you mental clarity and a serious strategic edge. You're no longer afraid of a small 3% pullback because you know the system will close your trade before the loss gets out of hand. The distance of a trailing stop is the fixed gap between the current market price and the trigger level. You set that manually. It's also called the step or interval. For example, you might choose 5% below the current price. But what's the right distance? That depends on how volatile the asset is. If a stock moves 2 to 3% a day, 5% might be too wide. You'd be leaving profits on the table. 1% could be too tight. You'll get kicked out at the first sign of a dip. A smart trader tailors that distance to each asset based on its average daily range. It sounds perfect. So why don't more traders use it? A few reasons. First, it's unfamiliar tech. A lot of beginners don't know how to set it up on their platform. Second, it's a mental game. Traders worry the stop will trigger too soon and miss out on gains. And third, it doesn't work well in sideways markets. Without a clear trend, it can take you out too early. That's why experienced traders only use it when they're confident in a strong trend. Sure, it takes research and conviction, but long-term, this tool can deliver steady and reliable results. We've just published a new article on our website. You'll find free content on stocks, bonds, and ETFs, from beginner to advanced. Check it out and bookmark the site. This tool is perfect for trend-based strategies. When you expect the asset to move in one direction for a while, it works great for breakout trading, trend-following setups, and holding positions based on fundamentals. It's also useful in short-term trading, especially for scalping or reacting to news. But in those cases, your settings have to be spot on. Even 1 point off, and the trade could close too early. So it's best to test your trailing stop setup on historical data first and match it to your system. When you're trading, don't forget, most decisions are emotional. Fear, greed, impatience, they throw even seasoned investors off balance. That's why automation tools like the trailing stop aren't just convenient, they're mental support systems. They take some of the emotional load off your shoulders. Instead of asking yourself, should I close this trade now or wait? You just let the system follow its rules. That not only protects your money, it saves your nerves. To get the most out of a trailing stop, you've got to consider the nature of your asset. Highly volatile tech stocks can swing 7 to 10% in a single day. If you use a 2% distance, odds are you'll be stopped out way too soon. On the flip side, if you're trading stable instruments like bonds or big dividend stocks, 5% might be overkill. So fine-tune your trailing stop settings using past data, support and resistance levels, and what's going on in the news. Hit that like button and subscribe. If you want to support our content, check out our membership page. The link's in the description or pinned comment.